Hi, Chris. How are you today?
Good, Dahlia. How are you?
Very, very good. Thank you. Chris, to start, tell us a little bit more about you as an investor before we get into the questions about how we adapt and thrive in this new environment we're heading into.
Yeah, yeah, for sure. Yeah, so I've been investing for quite a while, actually, since 1992. Started doing flips here in Canada, moved to the US, did some more flips, subsequently moved back and formed a business and started doing it more like instead of a secondary focus, it started to move more toward the primary, which was a really interesting shift. Subsequently done rent to owns, wholesaling, student rentals, and now focus on BRRRR in residential, so singles to doubles and now triples with ADUs. And BRRRR is an apartment building, same thing, different details, same framework, same model as we all love the BRRRR to be.
Yes, you've touched pretty much every strategy that I know about. So that's fantastic. Um, Chris, we've been getting a lot of questions from investors about the uncertainty in the market. As you know, rates are rising, values are changing, qualification is tightening a little bit on some fronts. And we're helping a lot of investors on many fronts, but I thought it would be really good to have investors like yourself share uh, what you're doing on your end to navigate this new environment that we're in. Are you seeing your cash flow impacted as a result of rising rates? How are you managing that, and what are you doing differently right now?
Yeah, for sure. It's the question on everybody's mind, right? Is how do you respond to what's happening in the most effective way possible? So yeah, and I will answer this in a couple of different ways. One is, steps leading up to this point, because we kind of know this type of change is inevitable. So what's been done up to this point, and then what am I doing right now, and then what can I and others do looking forward? So leading up to this point, I mean, this is like answering the question of, what if I can't place tenants? Well, the answer to that question starts way upstream, and picking the right market, the right strategies, the right analysis on the deals, the right renovations in that case. In this case here, how do we prepare, moving into an environment like this? Well, similarly, it's picking the right markets, especially the right strategies though, and then analyzing the deals in a way that sets you up for success once we see this type of change happening. So in the analyzer that I use, I literally have a pie chart that breaks down mortgage pay down, market appreciation, and cash flow to show you where the wealth is coming from in that predictive model. And the cash flow, the important message here is the cash flow is the smallest slice of the pie, but one of the most important. And why? Because of what's happening right now. We want that cash flow there so that we can handle a rent reduction, or we can handle an interest rate increase like we've just seen, or a couple of them. So stress testing those deals and making sure that we understand how are we cash flowing. And because, a lot of investors could handle one property that's negative cash flow 500 a month. And if they were, had that money, they could handle that, but it doesn't scale. It doesn't scale to 10 or 20. And even if you could handle that negative cash flow, we don't have to do that. So why would we, right? So it's a lot happens upstream leading into this in terms of prioritizing the types of investments, the strategies, and the cash flow. So that's really important, right? And that's a lot of the lead into this. Now, what if you're here, or regardless, now we're here. So now what do we do? This is, I would encourage, and it's what I'm doing, right? Reorient back to the fundamentals. Every business is the same. There's top line revenue and expenses, and the delta in between is where we make our money. And so during these times, it's good to look across the portfolio, and a portfolio view is very important, in my mind at least, and look at top line revenue. So where can we increase top line revenues? Where can we cut costs in a sustainable way so that we can weather the storm? To use that expression, right? Like the interest rates have gone up. It is tightening cash flow. It makes people kind of can instill some fear. And so if we can increase top line revenues, for example, rent increases in 2023, 2.5%, that's the most we've seen in a number of years. Absolutely take advantage of that. Look for any turnover in the tenancies that you can, especially for tenancies where the rent is below market. So look for those ways to increase the top line revenue across the portfolio. And then looking at cutting costs, right? Like it's one of the reasons why we champion, a geographic focus, is because operationally now we can be more efficient with our business. So lawn care, snow removal, property management, look across the portfolio, try to consolidate those resources to get volume discounts in a win-win sustainable way with you and that vendor, so that you can kind of, again, increase the gap between the gross revenue and the expense base, and maximize your profits during these times.
I love your reminder about the fact that we should look at our portfolios as a business and look at the top line and the bottom line. The cost of money is increasing, so doesn't mean we should just focus on that interest rate. And that's what I'm hearing in your messaging here. On the cost front, there are also opportunities to optimize how financing may be structured in a portfolio to actually enhance the cash flow. So that's just a comment on the cost front, because you touched on both. But yes, I love that. Yeah. I love that.
Yeah, absolutely. Yeah.
So you're relaxed, you're chilled. Why aren't you panicking given all of this scary words that the media is using right now? The rate hikes, right. I don't know what the other word is, but just you read the headlines and you feel the anxiety going up. Why are you not panicking right now?
Yeah, well, there's a couple of reasons for that. One is, and I'm a long time believer that the number one variable that we can manipulate to make ourselves happier, to be more successful in personal and business right across the board, is mindset. And I've had the good fortune in all three of my careers to work with some people that had fortitude through the roof. They were, metaphorically, obviously, they're the mountain, and the weather systems are moving through. It's snow, hail, sleet, whatever. And they're the mountain right in the middle, staying strong and true. And that's inspiring for me. And it's a target for me to keep shooting for. And mindset's one of those interesting things, right? If we're doing it right, it'll be a lifelong endeavor. It's not like, oh, I took care of mindset last year, now I'm good. It's something that kind of continues to evolve. And part of that mindset is, just like you said, like we get barraged from the media with a lot of clickbait, a lot of fear mongering, interest rates, Bank of Canada interest rate doubling. Well, that's an interesting headline, but it can be very deceptive when the rate's very low. And so doubling, it doesn't really, it's still incredibly cheap money, right? So,
yes,
that's a part of that mindset. And some of it too is experience. I mean, as I mentioned, I've been investing for a long time. I've personally felt 3 corrections, 3 pullbacks. This is the 4th, and they don't last, right? They're a point in time. And when you combine that with data, a study I cite quite frequently is a 150-year study, 13 of the major centers around the world, all investment types in real estate. It performs everything. We just think of the gravity of that study and what it's producing. That's very compelling. That's why we get into this to begin with, right? We believe in the asset class. And this is now, when you kind of contextualize it in that broader perspective, this becomes a detail. This is a detail that we need to be very smart and pragmatic about how we manage to it. But it's a detail, and unless something very dramatic changes, far bigger than this, we draw from that 150-year study, and we stay true, we reorient to our why, and we stay focused.
That's beautifully said. And I am on the same page as you when it comes to mindset, because anything can change around us. And what we need to focus on is what we can control. And this is what we can control. That's what's going to inspire the right actions, the right thinking. So I can't agree more with you. And I loved another thing that you said with respect to going back to the fundamentals and the basics. And that is also key. How can we plan around the fundamentals? How can we look at the data and not just act out of emotions? And you did refer to your deep experience. And also that's key in an environment like the one we're in, because advice and leaning on the right professionals and leaning on the right advisors to guide and calm and put things in perspective is really important versus listening to the headlines and listening to the media and picking on these words that are designed literally to scare everybody.
That's right. That's right.
Yeah. So
absolutely.
I love everything that you've highlighted, Chris.
Yeah, thank you.
Where do you see the opportunities ahead for investors in terms of investment strategies or markets? What do you foresee?
Yeah, well, I mean, I think that one of the most succinct ways to kind of articulate the response to that is, 6 months ago, we would have begged for this buying experience. Not only are the prices lower, but the buying experience is so much better. I mean, I saw, it was only a few months ago, I saw a 30-unit multi-go, multiple bids, sight unseen, firm offer, no conditions. And for me, I mean, I can't walk away from that deal fast enough.
Yes.
Again, even if that should be a cash buyer, if they have a lender, that's not smart, right? Like, what about the environmental and remediation of environmental issues that might come up? That risk is very high. And if they're a cash buyer, okay, they've mitigated that risk. But the buying experience, anyways, the point being, the buying experience was so competitive and just ratcheting up more and more and more. And so this represents a very needed balance in that respect, and makes the buying experience far more manageable. Allows us to kind of, and we've always been, and I know we're singing from the same song sheet on this stuff, watching the numbers and staying true to the numbers, and making sure, even in the crazy market that it was 6 months ago, that we're not derivating and becoming untethered from that fundamental. But today it's much easier, right? We can stay true to those numbers far easier. So on the residential side, we've seen a 15-20% drop in those prices. That is phenomenal for us. Especially in a market like a secondary market, where the ARV had a bit of a question mark on it, just because that market wasn't as evolved before. Now the ARVs are reasonable, but the purchase is much, much better. Now the delta between the two is far more favorable.
Yeah.
This is lots of opportunity.
Yeah. We're also, on that note, starting to see offers that make sense. In the market 6 months ago, multiple offers, competitive offers, above asking pricing, firm offers.
Yeah.
To your point, apartment buildings with firm offers going in, not knowing if the environmental is going to be fine or not. So the offers are starting to make more sense. There is negotiation room. And from a number standpoint, you've highlighted the ARVs, but are you starting to see better cash flow now that the prices are lower, despite the fact that the rates are higher?
Yeah. So yeah, great question, because there's a relationship between, think of a turnkey duplex, for example, just like a simple 2-unit. There's a relationship between purchase, rent, and interest rate. And so those three things triangulate off each other. And so that's a really useful tool for us to be able to use when we think about cash flow, when we think about stress testing our deals in today's market looking forward, because the rents, as we know, the rents are getting slightly stronger. They don't dip like the market does when there's a market dip. And so now we've got this, one leg of the stool has remained somewhat constant, if not strengthening a little bit. Cost of borrowing went up, so the price goes down a little bit to match the cost of borrowing. So it's a very simple kind of relationship between those three things. But when we're duplexing, for example, that stabilizes the ARV, because the rents are unknown quantity. Now the interest rate has gone up. Now we can fairly predictably model what that ARV is going to be, and to your point, cash flow quite well, and still produce these cash flowing properties by creating extra units in them. And even better than that, once we understand that triangulation and that relationship, then we can look forward and say, okay, do we think it's going to go up another half point? Well, I can pretty predictably assess my ARV and what this deal looks like for me over the next year, just by understanding that relationship.
Yeah, very true. And for listeners who don't know what an ARV is, folks, it's an after reno value. So what the property will be worth after renovating it.
Thank you. Yes.
Yeah. Well, that's fantastic, Chris. Thank you for your perspective. Is there any last thoughts that you'd like to share with the audience? If you were to share the biggest tip, what would that be to adapt and thrive going forward?
Yeah. Well, I think for those who maybe have lost sight of it, just remember, like everything in the world is in a constant state of adaptation. That literally everything is, right? And so the market is no different, and we should be no different. This adaptation that we're doing right now isn't to be unexpected, it's to be anticipated and embraced, right? The faster we embrace it, the quicker we make the changes that we need to make, the more pragmatic we'll be. And we know scientifically, right, that heightened emotion reduces clarity of thought. And so we want to kind of stay calm. We want to know that this adaptation is not to be feared. It's not to be resented. It's to be embraced. If not leading into this, then going forward for sure and through it. And again, realign to the purpose, right? Look at that 150-year study, the 53-year trend in the GTA. Remember why you're doing this, and that this will be a blip. We will look back on this and say, yeah, that happened, and it created a little bit of stress, but we stayed smart, we stayed clear-minded, and we got through it. And now we're thankful. In 5-10 years, everybody's going to be happy they own the properties they have.
Yeah, that's a beautiful reminder. And exactly the same emotions that we're seeing right now, we've seen when the stress test was introduced in 2018 and property values dipped a little bit. We saw it when COVID hit, and some investors panicked about even keeping the properties given the restrictions that surfaced at the time. And now looking back, we're here.
Yeah.
Investors still made money, and it's about, like you said, grounding and focusing on the fundamentals and adapting. And one of the things that I'd like to add on the adaptation front is planning and looking at the numbers reduces an anxiety. Because you may think the monster is this big, but once you see numbers and once you plan and you talk to the right advisors, that anxiety will calm down because you know what things would look like. It becomes clearer. So
Absolutely.
Can't agree more on that as well.
Yeah.
Thank you. Go ahead.
Yeah, no, it's such a great point because it's not usually the picture itself that's scary. It's not being clear on the picture. Right?
Yes.
That's where it's that unknown, right? It's, all fear stems from the unknown, and that plan alleviates that unknown, creates good options for you. And I couldn't agree more. It's dead on.
Yeah.
Thank
you so much. We appreciate your time and being here today.
Thank you, Delia. Anytime.
Thank you, Chris.
All right. Thanks.
Bye.
Bye-bye.